Hello, this is Jimmy Lapping, and here's a second video on markets today, this time focused on metals and especially gold. Metal prices have interested me for a long time, not in the last place because several of them can provide some useful indicators of the state of affairs in the economy and in financial markets. Compared to some other metals, gold has a relatively limited use in industry but is often considered a safe haven when there is economic contraction, panic in the financial markets, geopolitical turmoil, or at least expectations of any of these. Apart from relatively short-term moves in response to such events or expectations, when you look at a long-term chart of gold versus several widely used paper currencies, for instance the last 20 years, you will see that gold is at or near all-time highs depending on the currency in which you express gold. Here you see a chart of the weekly close of the gold price in euro terms over the past 15 months. That is from the 22nd of July of 2022 until the end of this week. And you see that we closed this week above 60 euro per gram of gold and just a bit higher than the previous high in terms of weekly close, which was mid-March when the Silicon Valley Bank panic kicked in. And especially financial stocks were hit hard, at least in the short term. Now, although currencies like the US dollar and euro are common ways to express the price of gold, these are not the only ways in which we can study movements in gold in a useful manner. And I'm going to share three additional ways that I find useful to check from time to time. One alternative way of looking at gold is via stock market indices and to either take the ratio of gold to a stock market index or, what I find more useful, to calculate the ratio the other way around. For instance, here, how many grams of gold would I need to buy the DAX 40, which is the German large cap index? This week, the DAX closed just under 15,000 euro, while gold closed just over 60 euro per gram, and hence the ratio that I calculate returns a value just under 250 this week, closer to 245 to be more precise. Expressed this way, we can see how these different subjects perform in a given window, a given time window. For example, looking at the ratio of this week's close compared to that of 15 months ago, we see that the DAX is a bit higher in gold terms than it was 15 months ago, albeit that the difference is less than 1%. We reached a low in March, where I have placed the vertical dashed line, which was when the Silicon Valley Bank panic happened, but it quickly recovered in favor of the DAX until the last 2 weeks, in which we have seen some serious declines in DAX strength again. I could provide other stock indices than the DAX, but as I indicated in my first video from earlier today, several major European large cap indices follow a very similar pattern. Another type of comparison that I find useful from time to time is Bitcoin versus gold. Here you see the monthly close of the price of Bitcoin expressed in ounces of gold since the start of 2018. Basically, we have three main periods, until late 2020, then until about May 2022, and a period from June 2022 onward. So in this chart, you could say that gold has massively outperformed Bitcoin if we take as starting point March or October 2021, but when taking early 2020 as starting point, we see that Bitcoin has done much better. This chart is only until the end of September, but the current ratio is around 15, which is quite similar to the September close. And finally, a ratio that I keep track of is the gold to copper ratio, here in this chart expressed in log format. I find this ratio useful as an indicator of the economy. As I mentioned earlier, gold tends to do well in times of reduced economic activity and has a limited use in industry. However, higher copper prices are indicative of increased economic activity and industrial demand. Although some prefer to calculate the ratio the other way around, copper to gold, I prefer gold to copper, meaning that increases in the chart indicate more movement towards gold than to copper. This chart presents the logged gold-copper ratio since early 2001 until last month's close, and although October has not ended yet, if gold and copper prices continue the trajectory of these past weeks, we will have another red print at the end of this month. So I have marked the periods in which the statistic was in interesting territory. The blue periods indicate relatively low values, hence in relative favor of copper, and hence economic activity and industrial demand with it, whereas the red periods indicate relatively high values, indicating a relatively stronger preference for safe haven gold. The longest blue period was from just after the bear market that ended at some point in 2003 until about the start of the financial crisis of 2008. Of course, the financial crisis meant reduced economic activity and relatively more movement into gold. Two other major peaks in the statistic we've had since are in 2015-2016 and last time from about mid-2019 to early 2021. Was the last one only COVID related? No, that would be an incorrect conclusion because we started to see a clear breakout in gold prices in June, July of 2019, which was well before the start of COVID and the lockdowns. Going into 2021, we saw a considerable move back from gold towards copper in the hope of reopening and recovery, but things turned around again, and part of this year we have been in red territory again. Will we stay in red territory for the next several months and even see another peak like this, peak like at some point in 2020? Well, no one knows the right answer to that question, but in the current climate, at least somewhat elevated values of this statistic are not strange. But at least the statistic is not yet showing an all-time high. Okay, that's it for today. Thank you for listening. And if you have any comments or ideas or suggestions for future videos, you can leave a comment below this video. Bye bye. See you soon.